Hello and welcome to Stockwatch Live. Now, I think it was Benjamin Franklin who's quoted as having said, "There are two certainties in life, death and taxes." So, investors in funeral group Dignity should in that case be onto a solid investment. And that did indeed look the case at the last results roundup, when the UK group said first half pre-tax profits had been better than expected because of a higher death rate. Now, it might seem, well, less than dignified and even pretty distasteful to associate a rising number of deaths with increased profits, but the fact is, whether you like it or not, death is big business. However, while this macabre business model would appear at first glance to be fail-safe, it turns out it's not. It's actually a lot more cutthroat. At an average cost of just under £5,000, funerals certainly don't come cheap, and here in the UK, Dignity has honed in on a lucrative gap in the market, which gives grieving families the opportunity to send their loved ones off with a dignified burial or cremation without having to pay through the nose to do so. But it isn't the only one to have spotted this opportunity. The cooperative group has also seen a need for dignified but more financially viable funerals. And as a result, it's been going head-to-head with rival Dignity on cost ever since. Now, Battle of the Undertakers may sound like a bad spoof movie, but when the co-op cut the cost of its simple funerals by £100, Dignity's share price immediately dropped by more than 6%. It wasn't helped either by a note from analysts at Peel Hunt, which said that if Dignity followed suit, it would reduce profits by around £1.5 million in a full year. With simple funerals making up 20% of Dignity's overall volume in the second quarter of 2018, up from just 7% in 2017, the co-op is hitting Dignity at the heart of its business proposition. Dignity had already slashed the price of its simple funerals by around 25% to match the co-op's prices. At the half-year stage, it said looking ahead that it expects 600,000 deaths for the full year based on the first half of 2018, but it added that 2019 is likely to see underlying profitability lower than 2018, although still in line with current market expectations. Peel Hunt says the shares are a hold, but has cut its price target from £11 to 950p. Berenberg hasn't changed its £12.50 price target or its hold rating since May. Now, onto something less morbid, although probably not any more uplifting, especially if you're a shareholder in Flybe. 3 of the UK low-cost airlines' top 10 shareholders reduced their stakes after the company announced a full-year profit warning that triggered a whopping 40% drop in its share price. Flybe, which said it couldn't comment on investors' decisions, did say that its strategy is to reduce capacity and focus on the most popular routes, and that had delivered higher load factors and increased revenue per seat. Alongside this, it said it was reviewing further capacity and cost-saving measures and would be updating on these in November. So, now we're in November, investors will be all ears when it posts half-year results on Wednesday. Flybe blamed weaker sterling and high fuel prices for its profit warning and said it would now make a pre-tax loss of about £22 million, against market expectations of a £3.5 million loss. Last year, the company lost £19.2 million. HSBC has just upgraded its investment rating on Flybe to buy from hold, but cut its price target in half to 20p. If you're interested in the house building sector, you're in luck. There are full-year results due from retirement homes builder McCarthy & Stone, alongside trading updates from Taylor Wimpey and Bovis Homes. Now, while much of the new build sector tends to focus on attracting first-time buyers, McCarthy & Stone is a bit different. It has its eye on what some have dubbed last-time buyers, retirees and pensioners who are attracted to their retirement village-style setups. Marketed to the over 70s, the McCarthy model relies on potential customers selling their large, former family homes and moving into one of its purpose-built complexes. With an increasingly ageing population, you could argue that McCarthy is well placed. However, a slowdown in the housing market, coupled with access to equity release mortgages, which allow older people to borrow against the value of their home and stay put, has meant many are doing just that. Plus, while builders targeting first-time buyers have been reaping the rewards of the government's long-running Help to Buy scheme, the retirement home builder has been rather left to fend for itself. Analysts now even believe the Help to Buy scheme may actually be harming McCarthy by encouraging buyers to opt for new build homes rather than choose existing properties of the type that its customers need to sell in order to move into a McCarthy & Stone complex. In April this year, the company reported a fall in profits of more than 50% over the 6 months to February. McCarthy cut the upper range of its operating profit outlook to £73 million from £80 million at its last profit warning just months earlier. Adding insult to injury to McCarthy's long-suffering shareholders, it was recently ejected from the FTSE 250 index, having seen its shares slump 30% over the past year. On the plus side, it has said it would hold its 2018 dividend steady. Investors will be interested to hear more about its plans to combat tough trading conditions that it continues to face. The company has already said it's decided to shift its focus from growing revenue to generating better returns on capital and higher margins, adding that it would right-size its operating cost base and bring about savings of £40 million a year by the 2021 financial year. It wasn't clear from the company's statement if job cuts were involved in the plan. Broker Peel Hunt sees value in the shares. It rates them a buy and has a price target of 150p. Barclays Capital is a little less convinced. It remains underweight, but has raised its target price a penny to 93p. Well, that's all for me for this week. To find out about the companies reporting in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.